Good day, everyone. Trust you're doing well today. Today, we're talking about what happened in the Nigerian stock market last week. Things have really changed from the last time I made my last market update video. In fact, the market has started falling. The headlines are turning negative. More stocks are losing value than gaining. And naturally, many investors are beginning to wonder, is this just a normal pullback or is it something much bigger about to happen? Well, in this video, we are going to break down exactly what happened in the Nigerian stock market last week and more importantly, what investors should be watching next. So let's get right into it. First, let's look at what actually happened in the market last week. The Nigerian Exchange had a very mixed week last week, right? So last week Monday, the market started on a positive note. The All-Share Index, also called the ASI, gained almost 1%. That may not sound much, right? But for a stock market, that is a healthy daily move. Many investors saw this as a sign that buyers were returning after the previous week weakness. Then Tuesday came, right? It became even better. The market gained another 1%, which was helped by strong performances from some of the bigger companies. Stocks like NGX Group and Transcorp attracted buyers, and confidence seemed to be returning. At that point, many investors probably thought the correction is over. But then Wednesday arrived and everything changed. The market dropped by more than 2% in a single day. That may sound like a small number, but remember, we are talking about the value of almost every listed company on the Nigerian Stock Exchange, right? In just one trading session, roughly 3.6 trillion naira was wiped off the market. That was the biggest warning sign of the week last week. Then by Thursday, the weakness remained. And by Friday, although a few stocks like Univision, Magnicos, and Leak Assure managed again, the overall market still finished lower. Finally, by the end of the week, the All-Share Index closed at 232,048,000 points. Now, here is something that often confuses people. You may have seen two different numbers being reported for the week's performance. Some reports said the market fell by 2.59%. Others said it fell by 1.65%. So which one is correct? Well, actually, both are correct. They are simply measuring different time periods. If we compare Friday, June 19th to Friday, June 26th, the market moved from 232,049,000 points. That is a drop of 3,892 points. So do not let those two numbers confuse you. They are both correct. Now let's answer the bigger question. Should investors be worried? Well, not necessarily, and here is why. Think about someone who bought a stock 2 months ago, right? Maybe that stock has already gained 30% or about 50%. Some stocks even doubled during the strong rally we saw in April and May. Now imagine you are that investor. Would you keep holding forever? Probably not. But from what I usually observe on Nairaland and X, Twitter, right? Some people really do fall in love with stocks due to strong fundamentals and then decide to hold forever. I laugh when I say this because institutional investors never fall in love with stocks. But anyways, at some point, some investors decided to sell and secure the profits they already made. This is called profit taking. So a falling market does not automatically mean the economy is in trouble or that a crash has started. Sometimes it simply means investors are taking some money off the table. But here is where things becomes more interesting because one number stood out last week and that number was market breadth. Market breadth simply tells us how many stocks went up compared to how many went down. Think of it like a football league, right? Imagine 56 teams played their matches, only 15 teams won, 41 teams lost. Even if one or two famous, well-known clubs performed well, would you say the league had a great week? Probably not. The same idea applies to the stock market. Last week, only 15 stocks gained, 41 stocks declined. That tells us the weakness was spread across the markets, across sectors. It wasn't just one or two companies dragging the market down. Another important clue came from trading volume. Trading volume simply means the total number of shares investors bought and sold during the week. Last week, about 2.3 billion shares changed hands. The week before, trading volume was over 3 billion shares. What that means is trading activity dropped by roughly 24% last week. Now, why does this even matter? because volume tells us how strongly investors believe in a move. If prices are falling and volume is very high, it usually means investors are rushing to sell. That can be a warning sign. But if prices are falling while volume is getting lower, it often suggests something different. It tells us many investors are simply sitting back and waiting. They are not panicking, they are just watching. That is why many experienced, investors describe the situation as, correction rather than full-blown crash. Now let's talk about one level that many traders are watching very closely. The market has now fallen below 235,000 points. Why is that important? Because this level has been acting like a floor, it's support. Think about the floor in your house, right? As long as you are standing on it, you feel stable. But once the floor disappears beneath your feet, your balance changes. That is exactly how support works in the stock market. When prices fall below an important support level, traders begin watching the next support. Right now, the next level is around 230,000 points. But you would ask me, what will change the current situation? Basically, what signs would tell us buyers are coming back to the market? Well, the first thing is simple. The market needs to move back to above 235,000 points. Secondly, we want to see stronger trading activity, not just prices going up, because that could be a sign of just retail buyers buying, and when they get tired, it falls again. But we want to see, strong participation from institutional investors. Thirdly, we want to see more stocks rising than falling. Remember the, football league example I gave earlier. Instead of 15 winners and 41 losers, we want the opposite. Finally, investors will be watching the banking sector very closely. Banks often lead the Nigerian market. When large banking stocks begin recovering, they usually help lift confidence across the entire exchange. Now let's look at the risks. What could make the correction become something more serious? One risk is if the market falls below 230,000 points with very heavy selling, that would suggest investors are becoming much more nervous. Another risk is continued, falling weakness in the banking and oil stocks. These sectors carry a lot of weight in the market. If they continue falling together, it becomes harder for the overall market to recover. Secondly, global events also matter. If oil prices fall sharply, Nigeria could face lower government revenue, which may, affect investor confidence. The same applies if the naira weakens much faster than expected, or if foreign investors decide to move money out of emerging markets like Nigeria. These are all factors worth watching over the coming weeks. But here is the most important takeaway from everything we've discussed today. The market is no longer moving higher like it was a few weeks ago. In fact, momentum has greatly slowed down. Selling pressure has increased and investors have become more cautious. However, that does not automatically mean the long-term story has changed. Markets do not move up in a straight line forever. Even the strongest bull market experience periods where prices pull back before continuing higher. In fact, corrections are often healthy because they remove excessive excitement and give new investors an opportunity to enter at better prices. So instead of asking, is the market crashing? A better question might be, is this simply a normal pause before the next move? Right now, the evidence suggests we are looking at a short-term correction rather than a complete change in the long-term trend. Of course, that could change if key support levels, break, or if economic condition becomes much worse. But for now, patience might be, more valuable than panic. So keep your eyes on the 230,000 levels. Watch how trading volume behaves. Watch whether buyers begin returning to the banking sector. Those clues will likely tell us where the Nigerian stock market is heading next. If you found this breakdown helpful, remember that market rewards people who understand what is happening, not people who react to every headline. Stay informed, stay patient. Now, if you're looking to get regular stocks recommendations and stock market tips for both Nigeria and US stocks, I have a Telegram channel where I share frequent market insights to enable you beat the market. So if you're interested, indicate your interest by sending me a mail via the email address in the description box of this video. If you gain value from this video, please like and subscribe so you do not miss my next video. All right. Have a nice day. Bye.